The market is dropping every day. And for people who own stocks, this is not only financial pain, this is also real physical pain. But there's a simple way to protect your portfolio. The easiest way, and in my opinion, the most effective way, is buying puts. So you might have some question, which strike price should I pick? Well, let's take a look. Here we're using an app called Optactic, and we scroll down to Merit Put. Let's use a theoretical stock called ABC, and the stock price, let's set it to 100. You can ignore the volatility right now. What you see here is the profit curve of this strategy. The horizontal axis is the stock price, and the vertical axis is the profit of this strategy. This strategy has limited loss. The loss is capped at this level. In fact, it's around $650. This is actually the cost of buying the put. And if we zoom out a little bit, you can see this strategy only has limited loss but a limited upside potential. If the market stops decline in the future and bounce back, you can potentially make a limited profit on this strategy. So which strike price should we choose from? Well, you have several options. You can either choose a strike price that's above the current stock price. That's called in the money put. Or you can choose a strike price that's out of the money, which means is lower than the current stock price. So if we choose a strike price that's lower than the current stock price, you can see the cost of this put has dropped to $250. The $10,000 is actually the price you pay for the stock. The actual cost of the put is the $250. So comparing to the previous strike price 100, the out of money put is cheaper, but you have less protection. Now your maximum loss has increased to $1,000. You have less protection. The put is cheaper, but your protection is less. So if you want more protection, you should buy a in the money put, which means the strike price should be set above the current stock price. As you see, you have much more protection than out of the money put. Here the maximum loss in this in the money put is 288. So that depends on your risk appetite. In my opinion, you want to hedge your portfolio, you want to protect your portfolio. You should buy at the money's strike price or slightly in the money. That way you have more protection. So the next question you might have is what should the expiration date be? Well, that depends on how long you want to hedge your portfolio. How long do you think this inflation risk gonna last? The Fed just starting to come back the inflation right now. Might take some time for them to see the result. So I would buy the longest put I can afford. This might translate to a slightly more expensive put. Here we can experiment with different expiration date. If we extend the expiration date, you can see the cost of this strategy also increase. But I think the protection justify the cost, and you will be worried free for a very long time. So now let's use a real example. Let's say you own some Microsoft stock. For the volatility, we can just look it up in the search engine. After we entered all the information for the stock, so here's the profit curve of the merit put. You can see the maximum loss is $3,000, and this is the cost of buying this put. So if we opens up the strategy details, you can see the composition of this strategy. In this strategy, you own 100 shares of Microsoft stocks, and the total value is $27,850, and the cost to put is $3,000. So you're using the $3,000 to protect your 100 shares of Microsoft stock. So the maximum loss in this strategy is $3,000, and if the stock turn around, you will have unlimited upside potential. The next question people have is, how many puts should I buy? Well, here is a simple way to calculate how many puts you should buy. Let's say you own 100,000 worth of stocks. Let's say we're gonna use the S&P 500 ETF puts to protect our portfolio. This ETF represents the broad market. The symbol is SPY. So the price of this ETF trust is 412. So divide by 412 equals around 242 shares. And we divide this number by 100, it's 2.4. So if you want full protection, you can buy 3 shares of SPY puts. If your long term is a little bit bullish, and you can buy less puts to hedge your portfolio. You can buy 2 shares of SPY puts. You should keep in mind that 2 shares of SPY puts only gives you around that much value of a hedge. So this is a little bit less than the $100,000 portfolio you want to hedge. But in this case, you are bullish, so this is fine. So here you are. I hope you enjoyed this tutorial. Please leave your comments below and enjoy trading.